If you've spent any time in the Forex market, you've probably noticed what I noticed early on. Price doesn't move randomly. It moves in response to something. And most of the time, that something is economic. Economics is the foundation of currency value. Every currency pair I trade, and every pair you trade, represents two economies in relation to each other. When one economy grows faster, attracts more capital, or raises interest rates, its currency tends to strengthen relative to the other. And that's not a theory. That's the structural logic that markets are built on. Now, I know most traders understand this in a vague sense. They've heard that inflation matters. They know the Fed moves markets. But there's a gap between knowing that economics is important and actually understanding how these forces work, what they signal, what they don't signal, and how they interact over time. That gap is what I want to close in this video. I'm going to walk through the 5 core economic factors that drive currency value, not as a checklist of what to watch, but as a framework for understanding why currencies behave the way they do. If you trade higher time frames, weekly, monthly charts, this kind of structural understanding isn't optional. It's the context your entire analysis lives inside. Let me start with what I mean by economic analysis in Forex. At its core, economic analysis is about understanding the health and direction of a national economy and using that understanding to form a view on its currency. That's it. It's not about predicting news releases. It's not about trading economic reports the moment they come out. And it's definitely not about reacting to every piece of data that crosses your screen. What it is about is building a coherent picture of where an economy stands relative to others over time. The 5 factors I cover in this video, GDP, inflation, interest rates, employment, and trade balance, are not isolated data points. They're interconnected pieces of the same picture. GDP reflects overall output and growth. Inflation reflects purchasing power and price stability. Interest rates are set in direct response to inflation and growth. Employment supports consumer spending, which feeds back into growth. And the trade balance tells you how much global demand exists for a country's good, and by extension, its currency. What this is not is a real-time trading system. I'm not suggesting you enter a trade the second a GDP number prints, or exit a position the moment unemployment ticks up. These factors shape trends. They tell you the structural direction of a currency over months and quarters, not the next few candles. That distinction matters enormously for position traders. Short-term noise and long-term fundamentals are two different things. Economic analysis belongs in the second category. So why do economics drive currencies in the first place? I think it's worth understanding at the root level. A currency is fundamentally a claim on the productive capacity of an economy. When people and institutions hold dollars, euros, or yen, they're holding a stake in what those economies produce, what they promise to return, and how stable their systems are. That means currencies are forward-looking. They don't just reflect where an economy is today. They reflect where investors and capital flows expect it to go, and that expectation is driven by economic fundamentals. Think about interest rates. When a central bank raises rates, it's responding to an economy that's growing fast enough or inflating fast enough to warrant tighter policy. Higher rates mean higher returns on currency-denominated assets. That attracts foreign capital. Capital inflows increase demand for the currency, and the currency strengthens. Now, trace that backward. The rate hike only happens because the economy was strong enough to support it. The economy was strong enough because employment was healthy. Growth was positive, and inflation was within a manageable range. Each factor connects to the others. That's why I don't look at these 5 factors in isolation. I look at them as a system. A strong GDP reading means more when it's accompanied by low unemployment and controlled inflation. A rate hike carries more weight when the economy behind it has broad-based strength. This is the structural logic that gave rise to economic analysis as a discipline in Forex. Markets need a framework to evaluate the relative value of currencies, and that framework emerged naturally from the fundamentals of national economic health. Here's something I've observed over many years of trading. Professionals don't approach economic data as events. They approach it as evidence. When a GDP report comes out, an institutional trader isn't asking, do I buy or sell? They're asking, does this confirm or contradict the economic picture I already hold? It's a filtering question, not a reaction trigger. and that's a fundamental difference in how the information is being used. I maintain what I think of as an economic thesis on each currency they follow. Something like the US economy is in a late cycle expansion. The Fed is near the end of a hiking cycle. Real yields are high. Dollar strength is well supported for now, but the thesis becomes fragile if employment starts to crack. That thesis gets updated with each new data point. It doesn't get reversed by one number. The same logic applies to every factor. A single strong employment number doesn't flip a bearish thesis, but several consecutive strong numbers combined with rising inflation and a hawkish central bank might. What I'm always looking for is convergence, multiple factors telling the same story. I'm also acutely aware of the relationship between what's expected and what actually happens. Markets price in expectations. If the market expects a rate hike and the central bank delivers it, the currency may not move much. The move already happened in anticipation. What moves markets is the gap between what expected and what was delivered. This is the priced-in concept, and it's why I believe understanding economics at a structural level matters far more than chasing individual reports. When you understand the underlying condition of an economy, you can anticipate what the market has already digested and what would really actually represent a surprise. The most common mistake I see traders make with economic analysis is treating it as a cause and effect machine. Strong GDP prints, dollar goes up, simple, except it's not. The breakdown happens because traders conflate the data with the outcome, without accounting for context. Here's a clear example. A country might report strong employment numbers, and on the surface, that looks bullish for the currency. But if the central bank has already signaled it's done hiking rates because inflation is coming down, that strong jobs number may not change anything. The thesis is already set. The data confirms it, but doesn't advance it. The currency might not move, or it might even pull back as a short-term reaction and sellers come in. Another breakdown I see regularly is recency bias. Traders see a trend in one or two data points and project it forward as permanent, but economic cycles are long. A few months of strong growth doesn't mean the expansion continues indefinitely. A few months of rising inflation doesn't mean runaway inflation is coming. As a position trader, I think in cycles: expansion, peak, contraction, recovery, not in individual data points. There's also a structural confusion between correlation and causation. People see that the dollar strengthens after rate hikes and assume that's always the rule. But rate hikes in a deteriorating economy, or when other central banks are hiking faster, can actually coincide with dollar weakness. Context changes everything. The solution isn't more data, it's a better framing. Understanding what each factor means, how it connects to the others, and where the current cycle stands, that's what's preventing these misreadings. For me, as a position trader, economic analysis has a clear and specific role. It sets the directional bias. When I'm holding trades for weeks or months, I need a reason to believe price is moving in a certain direction with a structural tailwind behind it. Economic fundamentals provide that reason. They tell me which currency in a pair has the stronger underlying economy. They tell me where capital is likely to flow. They give my trade a rationale that goes beyond the shape of a candlestick. And used this way, economic analysis is enormously valuable. It helps me avoid trading against the current. It helps me hold positions through minor pullbacks because I understand why the move is happening. It helps me think about risk in terms of changing conditions, not just changing prices. But I want to be honest about the limits, because those limits matter just as much. Economic analysis is not a timing tool. Knowing that the dollar is fundamentally strong tells me nothing about when to enter a trade, where to place my stop, or which technical level to watch. For that, I still need chart structure. Economic analysis defines the direction. Technical analysis defines the moment. It's also not a short-term tool. If you're trying to trade news releases or day trade economic reports, you've moved outside the domain where fundamental analysis applies cleanly. Short-term price reaction to data is noisy, fast, and often counterintuitive. And finally, I never use economic analysis as a replacement for the full picture. The article this video is anchored to describes 3 layers of analysis: fundamental, technical, and sentiment, and each has its role. Fundamentals define direction. Technicals define structure and timing. Sentiment gauges where the crowd is positioned. All 3 work together. Economic analysis alone is context without execution. Technical analysis alone is execution without context. You need both. And what I've covered in this video is not a trading system. It's a way of seeing. When I understand that every currency pair is a comparison of two economies, and that those economies are always in motion, always cycling, always responding to growth and inflation and employment and trade flows, I stop looking at charts as random noise. I start seeing them as a visible expression of something structural and real. That's what I believe separates patient, disciplined position trading from short-term speculation. It's not just a time frame, it's understanding. The 5 factors we've covered, GDP, inflation, interest rates, employment, and trade balance, are the foundation. They don't give you trades, they don't give you orientation, they tell you which way the river is flowing. And my job as a position trader, and yours, is to move with that flow, not against it. The full framework behind this video is covered in detail at positionforex.com. The article, Economics in Forex Trading, 5 Essential Factors to Know, walks through each economic factor individually, explains how they interact, and outlines a 3-layer analysis model that connects fundamentals to technical and sentiment analysis. You'll find the link in the description. Read it alongside the video and use it as a reference as you build your own economic framework for position trading. And until next time, best year trading.